Hi again, George. Okay, that's cool. Right, have you got headphones as well? Okay, all right, that's cool. Okay, so should we see how we get on like this and see how it goes? All right. Um, so you can see my screen. It's got a chart on it. Okay, that's excellent. Now, before I really get into it, you said you hadn't really done any trading before. And can you just give me a bit more background about your interest in trading? What's your background interest? Okay, so my stuff is really about teaching people a little bit about how to read the charts and how to think about trading. It's not talking about the economics of it hardly at all. Um, so so it's kind of like it may or may not fit with what you're doing, with your A levels or whatever. But who knows? It might do. Mm. Okay, cool. So what I'm going to do now is I'm going to switch over to a PowerPoint presentation. We'll run through that, and I'll take you through step by step as soon as I find the PowerPoint presentation. Actually, it should be here somewhere. Right, we're nearly there. Right, with that screen. Yeah, page up. There you go. All right. So that's the starting screen there. About technical analysis and the keys to trading. Okay. So the first thing I've got to do, because this is all like, it's going to be talking about trading and how you can trade and stuff like that, I've got to give a disclaimer. So the first disclaimer is that one there. If you can read through it, but basically it's saying that, trading is a risky business, right? And you can make money, but you can also lose money, and you can not only make a reasonable amount of money, but you can lose a load of money. So anything that you do with regard to trading, you need to be taking real care with it, and only using money that you don't care if you lose it all. Okay, so often I think when I'm showing people how to do stuff, I would talk through it all, and I'd suggest that in the first instance, if you're going to do it at all, do it with a demo trading account where you can open it up with fake money, and trade with fake money probably for, I don't know, 2 or 3 months until you get used to it. At least that way you're not going to lose any real money, and you can find out whether or not it suits you or is interesting to you or not, and take it from there, right? Okay, so that's that disclaimer. There's also another disclaimer, which is a legal requirement, which is this CFTC Rule 4.41, which is a hell of a mouthful. Uh, and it basically says this lot here, which is basically hypothetical or simulated performance results have limitations, and unlike real performance results, do not represent actual trading. Okay, so at the bottom, no representation is being made that any account will or is likely to achieve profit or losses similar to any of those that might be shown. Okay, so we're moving on into what we actually want to introduce you to in regard to trading. Ask any questions as we go along, okay? But the first thing that we want to look at is line charts, which was the screenshot that I showed you just a minute ago, which is let me find it again. I think it's that one. There we go. Okay, so there's a line chart. Now I guess you know loads about line charts. You understand this kind of stuff. Yeah. All right. So the next thing I want to talk to you about then on a line chart is the concept that when people trade financial assets, it sounds like you've got somebody else in the room as well. Yeah, yeah. I'm just aware that you might not be able to concentrate if you've got somebody else talking to you at the same time. All right. Okay. All right. Cool. So this is a line chart, and with the stock market and any financial asset, um, there are certain price levels at which it reaches where people know that it's overpriced or know it's underpriced. And it's the same when you go down to the shops and buy anything. I don't know what you might go down to the shops and buy, but what sort of things do you go and buy typically, George? Okay. All right, that's cool. And when you buy records, are they vinyl? Are they sort of CDs or whatever? They're vinyl. Okay. So with a vinyl, you'll find that there are sort of prices for new vinyl, which is probably quite hard to get hold of these days. I don't know. And then the second-hand prices of vinyl, and the price will be whatever it is. But sometimes you go, "Hell, that's cheap," and other times you go, "Wow, that's too much for me at the moment," right? And so this is the same with the FTSE or currency or anything. So looking at this chart, I'm going to pick up this. This is called a MetaTrader platform. This window that you're seeing here is based on MetaTrader, and I'll tell you all about MetaTrader later when we get to it. But basically, it's a charting package that allows you to look at all sorts of different financial instruments, and it creates charts for them all. So that's right. FTSE 100 is the FTSE 100, which is the top 100 companies in the UK. Okay. Yeah, what it does is it takes the share price value and the market cap, and it has an algorithm that smooths all that lot out, and it gives a value of the overall stock market, a collection of the 100 top stocks. Okay, and that number is calculated in real time. I mean, it's changing all the time. Somebody's making calculations, and you'll see on the far right hand side it's reading at the moment 6825.4. Don't know how well you can read that on this screen. It's really tiny on MetaTrader. And now it says 26.2. You see, it's changing while we're watching it because this is a real price stream that's going on, and these are because the stock market's closed. It closes at 4:30. The UK stock market closes at 4:30, but the American stock market is still open, still trading. And some of the stocks that are traded on the American market are the same stocks that are traded on the UK market. And the market makers are also making prices for the UK market even when it's shut. All right, so this is a strange computation at the moment because the UK market's actually closed, but the prices are moving. Yeah. So that's something else to bear in mind if you're trading the FTSE. The best time to trade it, really technically, is between 8 o'clock in the morning when the market's open and 4:30 in the afternoon when the market's closed. That's because that's when people can buy and sell shares on the UK stock exchange. So that's when people can actually trade. So it's like that's when the shops are open. No, that is during the day between 8 o'clock in the morning and 4:30 in the afternoon. No, sorry, my mistake. Between those hours, okay? So it's like having a shop that opens at 8 o'clock and it says, here's a bundle of stocks you can buy and sell, okay? So like a bundle of LPs or something like that. And you can just buy and sell all the way through that. And at 4:30 they shut the shop, and that's that. Except for it's not quite that, because the American market's open and stuff's happening, and the people that are looking after the pricing of the things in the shop are changing the pricing in the things in the shop, even though it's shut. Mm. No, some of the stocks that are traded on the American market are UK stocks, so that will happen. And the other thing that happens is there's this bit about I suppose sentiment and what people think things are worth. So if American stocks trade higher and start to increase in value, even though the UK market is technically shut, the UK market is likely to open up the next day at a higher price. And yeah, so the shopkeeper the next day is going to open it basically and say, hey, look, guys, it might have cost you, £2.39 last night when I closed, but hey, prices have gone up overnight and it's now £2.54. So that kind of stuff happens, and then there's this thing where the FTSE itself, which is the conglomerate, the aggregation of all of those, that price is adjusted by the market makers even though the market's shut. So what you're seeing here is that price being adjusted second by second as people go, oh, it's going up in America, oh, it's going down in America, right? So does that kind of make sense? I mean, it's it's an odd thing, but that's the way it goes. And then when you look here at this particular chart, you'll see these price levels, which we call support and resistance. And I'm going to put this. I'm going to click on that horizontal line bar there. Can you see me pointing at the moment? Okay, you see that? That's a horizontal line, and we can put a horizontal line on the chart. And if you look at this, this is a high point, and that's a high point, and that's a high point. So if we put that across those high points, you can see that where it's come to just now is back up to the same high point. Yeah. Now this previous time it reached that high point, I'm going to move to this crosshairs. So there, that was the last time it got to that high point. And this was on the 4th of September 2014. And just now it's come back up to exactly the same high point. It's taken all these zigzags around and it's come back. And it's got to the high point, and people, when it gets to that high point, there's kind of inbuilt psychology that you know, like when you're dealing with LPs or anything like that, you go, oh, hang on, that's a bit expensive, that is. I don't want to pay that much for it. Yeah, and so it comes up to hit that high point, and people are going, oh, hang on, that's a bit expensive. I don't want to pay that for it. You can never tell. There's things called breakouts, because you've got a high point here, which is in June, looks like. Yeah, June, 8th of June. And then we've got another one here, which is the 4th of July. How about that, American Independence Day. And then we've got another one here on the 4th of September. So that's 2 months later. And now we've got another one here, which happens to be the 3rd of February. Yeah. Yeah, I don't know all the ins and outs of it, but you're right. There was a lot of that going on. I'm not sure exactly when that was, but I think it was during this period here. You can see this big push down here. And we could check it, we could look at the stock and find out if that's so. But you can see it reached this high and it wobbled around a bit while everybody's going, hmm ha. You know, that was a bit expensive. And then at some point around here, everybody went, nah, and down the price went, right? And that's when everybody decided, no, I'm not going to pay that for it. And this is a bag of things. It's 100 companies. So at this point, everybody decided, no, it's too expensive. I'm getting out. So what's happened here potentially is that when the price moved down to this level where I'm pointing now, everybody said, oh, that's a bit cheap, I'll buy it. So they started buying stuff, and it got up to here, and it said, that's a bit expensive. I think I'll sell my stuff. And at this point here, everybody said, I'll sell it. And down it went. At this point here, everybody went, oh my gosh, that's cheap. And up it went. And at this point here, everybody said, well, I think I've banked all the profits I can make at the moment. I'm going to get out. And it went boink, back down again. At this point here, everybody said, Christ, that's as cheap as it was back there, and I couldn't get a chance to buy it then. I'm going to buy it now. So they bought it now, and up it goes. And at this point here, everybody goes, ooh, I think I'll take my profits, and down it goes. And everybody goes, well, it's still cheap, so up it goes again. Yeah? And it's about the human psychology. It's literally the same as when you go down to the marketplace or a shop or anything like that. You've got an idea about what's expensive and what's cheap. And people just react to those prices. And at some point, somebody will move it, what they call a breakout, will move it beyond the price where everybody said it was expensive before. So we've got an expensive price here, an expensive price here, an expensive price here, an expensive price here. And at the moment, it's joggling around because everybody's not sure what to do about it. There's a pile of people that have taken the move up here, selling off stuff, whatever it is they're selling, and then they at this point here, they're selling. But there are a few people here still buying because they're thinking, no, it's still cheap. So there's a big old fight going on, and this is the fight between what they call the bulls and the bears. And the bulls are the people going, yeah, 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 bull, bull, you know? And the bears are the one going, no, 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 I'm going to get rid of it. So at the right moment, what you're watching is a fight between the bulls and the bears at a point where we've hit a price level where everybody said it was expensive 3 times in a row. You know, 1, 2, 3 times before they've said it's too expensive, sell it. So we're watching this fight go on, and we don't know what's going to happen next, really. The price might go up, and everybody say it'll break out, which is breaking above this level, or everybody might go, no, 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 and it'll come back down again. So does that make sense so far? So then as a person that trades, what you want to know is where these levels are, because clearly it's human psychology to a large extent. You know, value is what people perceive value to be. Okay, so value is not real. It's sort of pseudo-real. As an economist, you might say it's real. It has a particular value. You can say that it has a yield, or you know, people would pay that much for it, and so on, because it's got that much value to it. But there's the psychology as well, where people will go, you know, that LP used to cost, you know, something like $2.50, and right now they're asking $5 for it. I'm not going to do that. Yeah, absolutely, absolutely. And pretty much everything everything is a derivative of how much we think about it, whether it's property prices or anything. You know, there's no real reason why a house should be worth whatever it is, 150,000, 300,000, or whatever it is. You know, it's just because if you look at the actual original building cost, they are whatever they are. And then there's the land cost, and then there's the subjective value. So you'll find properties that are, if you like, the bricks and mortar might have cost 100,000, but they're being sold at 600,000. Yeah, because people go, well, that's worth it. You know, it's in a place I want to live. It's right. You know, commuting distance from wherever it is I want to get to. I like the view, I like the neighbours, wherever it is, and so it becomes expensive. Yeah, yeah, and it's the same. It's the same here on the stock market. Everything is all the same, really. People put a value on it based on what they think. It's based on what they think their mind value, their psychology. And so, of course, things can go down in price because of the psychology as well. If everybody gets worried about the price of a mortgage, or they say that area is not so suitable anymore, then the price drops. Yeah, yeah, absolutely. Mm. Yeah, exactly so. Exactly so. And it's the same in any asset at all. Because at the end of the day, pretty much everything you buy and sell, and it's all the speculation, the psychology, and the fear, and the greed, and so on. And the charts tell you where, at least where the levels are, where people think like that. So we can put other lines on this chart here. We can put one, I don't know, we can start filling in all sorts of lines. If I put one across there, what happens? You see that was a drop down where I'm pointing now, there. It pulled down to there, that dropped down, then there was a bit of noise around here where the bulls and bears were having a fight, and then up it went, and then it came back, and it broke through this level and came down to here, but then everybody started to think it was worth a bit more, and it came back up again, and then it came down. But what's very interesting as well, if you start putting lines like this in, where there's a bit of consolidation, as they call it, people having the bulls and the bears having a fight, over here it came back to more or less the same level before everybody decided to get out of it. So you can see that these areas are areas where people have a change in perception of value. Absolutely. Yeah, absolutely. So they've got a built-in, people that live and breathe this have a built-in idea about what those prices are. But they also use software like this to put lines on the charts. I just put a few more lines on like this and just put them on underneath each of the different bumps and see what we can see, you know. So we've got this consolidation here, which is the same as this one over here, over there. So we've come up from there and we've hit these two lines. And then at that point, the bulls and the bears are having a fight. It comes down to this line here, which happens to be the same as that one and that one. And it comes down, breaks through it, rejects it, comes back to here, and then finally crashes through it all. Yeah, and then this low here happens to be more or less the same as that high there, after it came bumping back up again, and then it got rejected again. So we had another fight here with the bulls and the bears, and I wouldn't mind, let's try putting a line on that dotted line there. See how it goes? As it comes down and goes up and down in that zone there. That happens to be exactly the same place. I mean, it's really weird, but it's the way it works. And you come down there, look at that. So that line at the bottom there comes down, hits that point, that one almost touched that point, and then came all the way back up again. Mm. That's right, that's exactly so. It gets down to the bottom here, and enough people here, you see it rejected, what they call rejected this level here. So it came crashing down, rejected this level, and came climbing back up again. And then it smashed down, and it rejected it again. So this is what, but then when they saw that, and they saw this come down here, everybody went, that's cheap. Let's leap in and grab what we can while we can. Yeah, so it's like on a sale day and everybody's sitting outside the shop waiting to get in at 8 o'clock and grab the stuff and trample over everybody to get it, you know, and that's where they're trampling over everybody to get it, and it goes whap right up fast as you like. No, it can't, and I can tell you, if we go from there where it's starting to stop doing whatever it's going to do, through to there, that's 5 days. See the number on the left there, 5. So in 5 days it went from rock bottom up to there, exactly. Yeah. So the ones that are here going, oh my God, I can't stand it anymore, I'll sell it. There's a whole pile of people saying, thank God they're flogging their stuff and I can buy it. That's right. And the people that sold there because they said, I can't stand the heat anymore, I'm getting out. You know, and then they go, oh my God, look at what happened now. I just sold it. I just lost whatever it was, and now, oh my gosh. And the guys that leapt in here, guys and girls that leapt in there, again, hooray, that's cool. Right, I got that far. Last time we had a place here where everybody over here, they call support becomes resistance and resistance becomes support. So at this point here, this is a support line. It's where there's a bottom, that's called a support. And they say that there's often a situation where a previous support becomes a resistance. So it's like having floors and ceilings. Yeah. So this one here actually was the same point as that resistance. It went whacking up, and it became a resistance. This support became a resistance, and it went back down again. And everybody knows this sort of stuff is likely to happen. And because they do, they've just gone 5 days, they've gone bang, more than some people have made all year. Yeah? Because it's a massive move. People have just bought and hung on to their stuff, have made nothing all year. But people have bought it here and flogged it there in 5 days, made more than the people have bought and held it for a year. Yeah, and they're going to go, hey, that's all right. There's a previous support. Let's assume this is a resistance. Let's just flog it. Yeah. Yeah, you can get a dividend. You basically buy the asset or part of the asset because you're buying a number of shares of a FTSE 100 stock. And Warren Buffett always maintains that when you decide to buy into a stock, you should treat it as if you're buying the company or part of the company. So you're becoming a part owner of it. And as a part owner of it, you are entitled to the dividends on the dividend payout days. Now, they vary for each company. So some companies don't pay a dividend at all. Some companies do pay a dividend. Some pay them quarterly, some pay them twice a year, some pay them monthly. And they're all different. And while you're holding that stock, when the dividend date comes, it goes ExDiv, it's called, and it means that on that particular date, if you hold the stock, you're entitled to the dividend payout. No, it usually drops on those days. So on the dividend day, when it goes ex-div, so the day before dividend, you can't always tell. You just have to look at the chart and make a decision about whether it makes sense to you or not. But on dividend day, when it goes ex-div, the value of the asset will normally fall by roughly the amount of the dividend. Now I say roughly the amount of the dividend because my experience shows that quite often it will fall more than the amount of the dividend. Because I think it's because people who don't understand the dividends properly see the price drop and go, oh my God, it's dropping, I'll sell. Right? So what will often happen is it will overdo itself when it goes ex-div. So sometimes and you have to study individual stocks to understand how they work. But sometimes a strategy is to wait for it to go ExDiv and buy 3 or 4 days later, because it'll go ExDiv, it'll get sold, and then 2 or 3 days later it will go on down, and then the people that wise up and go, you know what, it's cheap now, so they'll buy it. But it's not always like that, so you can't tell always. So yeah, and the dividend actually goes into your bank account typically between 20 and 40 days after it goes ex-div, so you don't get the money straight away. Okay. It when it goes ex-div, anybody who owns it on the day it goes ex-div is entitled to the dividend. So if you bought it the day before and then the next day it went ex-div, you'd get the dividend. Yeah, but you'd lose the value of the price. Now, it's not always true, George, because quite honestly, sometimes it will go ex-div and it will rise. And that's a stock where everybody thinks it's absolutely fantastic. So even though it's paid out a dividend, it will actually end the day higher than it was when it closed. But for other things which are fairly neutral, when it closes and goes ex-div, it will drop in price. Totally, totally. I'm just giving you loose observations, if you like. This is what's likely to happen. Each individual stock will behave, differently. So you need to then understand whether that's true on any individual stock that you're looking at, and follow the pattern over time, and see what people typically tend to do with it. So yeah. So we've sort of covered we've covered the line charts, we've covered support and resistance in principle, and you can see how that works. We covered price, we covered dividend. Okay, so are there any other questions before I perhaps take you on to another piece of this trading puzzle? Yeah, sure. Okay, it's an index, and indices are like the plural of indexes. So it's an index of the conglomeration of 100 stocks joined together, and a price is given on that based on the prices of the 100 stocks that are in the FTSE 100. It's more complicated than that. But basically, for example, some stocks like British Petroleum and some of the tobacco companies and some of the pharmaceuticals, they're worth more money overall than some of the smaller companies in the FTSE 100. Yeah, so let's say one's worth, I don't know, 20 billion or something or other, and another one's worth, let's say, 500 million. Then they don't have the same weight. So this index takes all of those different weights into account and aggregates them and creates an index of the aggregate. Yeah, the bigger companies have more weight than the smaller companies. So if a big company rises, it will have more effect on the FTSE 100 than if a small company rises. Yeah, because it's a bag. It's like shoving all of them into a bag, and then it calculates all of that lot based on their weight. Yeah. Okay. All right. So then, this is basically the idea about support and resistance, which is one of the core principles to get in mind. Horizontal support and resistance are the ones that we've been looking at, and so we can see a number of them around here. There's another line there. Look around there and there and there, and that here gets penetrated here. There, that's a support. Yeah. It goes through, it breaks through support, or it breaks above. So here it's coming down to a support level, coming up, going down to support level, coming up. Then it breaks through support, and then it comes down to another support. And then it comes up and hits a resistance, but actually broke right through the resistance, comes down, hits the support, breaks right through, comes to another band, breaks right through. So sometimes it stops when it gets to certain levels, and sometimes it goes through, and it all depends on the bulls and the bears. That's exactly right. Okay. So that's basic support and resistance, and those are the most important things to understand about it. And I'm sorry, I'm just looking at the clock and things like that. I'm getting up to my bump of 7:30, so I might have to close the call pretty soon. So if you've got access to any charts anywhere, you might like to look at that. Or what I can do is I've been recording this all being well, and I can send you a copy of this recording, and then you can go through it all again on the recording and think about what you might think about it. Ask any questions you like on the next week. Yeah? Alright. So next time we'll be able to get connected a little bit early. We've got all the technology more or less sorted. We'll be able to get straight on and get on with the next session. Yeah, yeah. I will email you a link about how to do that. All right. And then I'll make sure that you got sorted with that. You'll be able to then run the same demo platform that I'm running, and then we'll take it from there. Okay. All right. I'm not sure when I'm going to get the link to you. It won't be straight away. Okay, but it will be over the next few days. All right. And same with the video. I'll see if I can get the video to you in the next few days as well, and then you have a chance to look through that and listen to what we've been talking about. Okay, George. Yeah, I'll send you that sort of stuff through. And if we book in principle the next meeting 6:30 on Monday. All right. Is there a better time for it? Oh, okay. Why don't you let me know what the best days are for you, and then we'll try and schedule it in when it's good for you. Okay, George. Have fun. Have a good evening. Cheers for now. Yeah. Bye.